Hello everyone and welcome to this Residential by Foundation Masterclass on complex residential cases. My name is Anna Sagar and I am Deputy Editor for Mortgage Solutions. Due to the turbulent economic climate over the past few years, more borrowers are becoming complex, whether that is due to switching to becoming self-employed, having multiple incomes, or that they are financially struggling. Residential by Foundation can help cater for this increasing tranche of complex residential cases due to the manual underwriting process, broad criteria, and wide range of products that they have. Today, Keith Jones and Paula Priest, National Sales Managers for Residential by Foundation, will give an overview of these topics, with Lisa Dowson, underwriter for the firm, joining us for the Q&A at the end. This will be about 5 to 10 minutes at the end, so please do submit your questions if you do have them. And without further ado, I'll hand over to Keith and Paula.
Oh, thank you so much, Anna, and a massive thank you to the Mortgage Solutions team for this opportunity. We really do appreciate it. And also a massive thank you to all you brokers that have given us business over the last couple of years. We really appreciate that. And for all those that haven't, we're very much looking forward to working with you, and hopefully we'll give you lots of reasons to use us by the end of this webinar. So just a bit for history then. As far as Foundation goes, we go back to 1998, so we've been lending in the market for quite a time, and we're owned by a massive American company called Apollo. In 2015, we rebranded to Foundation Home Loans, and that's the brand that we've operated really successfully ever since. As a company, we're based in Bracknell and we employ about 300 people, and we've been so successful. In fact, we're a 5-star FIFO award-winning service provider, and that's because we put customers first, and that's not just your customers, but our customer, which we see as you, the broker. In fact, we're an intermediary-only lender, so we only get business from you. People can't come to us direct, so you are really, really important to us. And that's why, we always make sure that you are the centre of everything that we do. As a lender, we've been really, really innovative. We were the first lender to launch short-term specialist Airbnb, and then we've evolved onto true holiday lets. We're the first to have green products in the specialist market, and also the first to have a 5-year fix with only a 3-year ERC tie-in. As far as the company goes, we've got 11 field-based staff that are all there and waiting to speak to you, and that's even before you dip a case. We don't want you just putting dips in or just putting cases in, and we appreciate that costs you time. So as a company, we're here to be able to speak to you. And we've also got 7 telephone-based staff as well that are also available at all times. As far as Foundation goes, we've got an absolutely wonderful culture, and all of us really do enjoy our work. And that comes, with the outcomes of the results that we get for you. And it certainly shows within our service. We're a really close company and we don't pass the buck. In fact, right up to my director and the CEO, we're all available to help and pull out all the stops when you do need us. So first of all, then, just to discuss Foundation and some changes that we made at the beginning of the year. We've got 3 brands. Historically, we've become really, really well known for buy-to-let, and that's what we've been doing really successfully since 1998. And that is your standard buy-to-let, your HMOs, your limited company, your multi-unit box, all your complex lending, along with massive portfolios, which our portfolio landlords love to bring to us. We've also got residential that we launched a few years ago, and this still contains some of the best kept secrets in the market. And Keith Jones and I are going to be talking you through all the reasons that Foundation can help you to place those cases that just don't fit the high street for whatever reason. And then lastly, we've got solutions, which we've not so long launched. Solutions is fantastic. It looks at large HMOs, multi-unit blocks, in excess of 10 units. We'll also look at 4 properties on one title, and mixed use and semi-commercial as well. But we're not going to be speaking about those today. We're going to be talking about how we can help you rescue those cases that are falling off the high street. So without any further ado, I'd like to get Keith Jones and introduce Keith, who will be more than happy to discuss what we will be running through and how we can add value in this 45 minutes. So hi, Keith.
Hello, Paula. Hi, how are you? You're well?
I'm fantastic, thank you.
Good stuff. What I wanted to do was obviously run through the detail about how we can help make those complex cases simple. That's what we're about, just making sure that actually there's so much we can do. It's just making it simple. That's the plan today. So at the end, obviously, there's questions which we can go through and answer all those as well. Well, you'll see the word first on there. Very sort of direct. We want to be your first choice when it comes to for intermediaries. We want to have that first level of service. We want to make sure that obviously everything's done for you. The first choice when it comes to lending in that specialist arena. Actually, we want to be that person to speak to. It's about trust. It's about integrity. It's about doing the right thing as well, which is what Paula's said earlier. And just making sure you're aware of what we do. Because again, unknown secret. We're a lender that people don't know enough about, and hence the reason for today's discussion. So if I run through the first points on here, we're going to cover off in the session. The F for not the previous slide actually, Paula. Sorry about that. Can we go back to that previous slide? Flexibility, direct access to underwriters, case discussion prior to the actual submission of the case, making sure that we actually show the flexibility, show the manual approach. Many years ago, manual approaches weren't really the thing, but now it's a case of we want to get into the detail, we want to know exactly what we can do, have that bespoke approach, that tailored approach to find out how we can make that case actually fit. So we're very good on the flexibility, very good on the manual approach, really want to make sure that case works. So underwriters are in there, we're in there as a team. We want to actually chat with you about the cases. So if it doesn't work, come to us, have that conversation. We've got so many options we can work through as well. When it comes to the income side, on the I of the word first, we've got so many options in there as well. So 1 year's accounts, latest year's figures, using net profit and salary. We'll go to explore more detail on that as well. Employed, variable incomes in there as well, professionals, key workers. There's so many options, contractors, day rate contractors, CIS contractors. Income's a massive thing for us. And that's our first port of call, really. So that's the thing that causes a lot of query, a lot of concern for brokers. Where do I go with this case with complex income? Come to us, we can find out that way forward. When it comes to the repayment strategy, again, an unknown position on that. We do a 40-year term, we can do interest-only lending, we can do part and part, interest-only and repayment together, obviously a full repayment as well. So there's all the options in there, and there's some really key strengths in there as well that we can explore in the conversation as we go forward as well. The service, again, we've said about that already, making complex simple. We want to add that level of service that actually, can I say, a high street lender you're typically used to doing things quickly, we can do that as well. And we've got a very long-serving team as well. I've been in the company nearly 6 years. I've been in the industry a long time, like Paula has. I think you said earlier, between us, we've got 63 years experience, which is obviously mostly yours, obviously. But yeah, in the sense of experience within the team, there's a huge amount there. And when it comes to the final thing on that first slide, the T is the credit profile. As a specialist lender, people think, oh, it's adverse straight away. With us, it's about all the things that come in before that. And then it's at the end, actually, we can do all that. And also there's an issue on the credit file. We can still make it work. So it's almost a sort of a byproduct to what we do rather than the first port of call for us. So there's lots of flexibility on that. We'll explore that in a few moments as well. So that first thing, we want to be your first contact for those key areas as well. There's obviously the next point as well, Paula, on the, yeah. So again, foreign nationals, we can help with foreign nationals. We'll go into detail about that. So there's some good things in that space as well. Again, because there's not that many options for foreign nationals, and we can be really helpful on those. Debt to income ratio, obviously debt's been repaid. People have come out of a difficult period over the last few years as well, and back perhaps in a better place and thinking, how do we actually make this even better than where I am now. And we can help with that with no debt to income ratio. We can sort out whatever you need within reason, obviously, but we can sort out those options. Family relations, we've got options on JBSP or joint borrower sole proprietor. We've got gifted deposit, gifted equity, 4 people within a family being on a mortgage as well. There's lots of options in that space to sort of help those. Again, it's lenders being innovative and making sure we've got other options as well. We've got mortgage prisoners. Sorry on the play on words on the slide there with the S being used for that. Probably a little bit sort of taking things a bit too far there. But again, mortgage prisoners, it's a case where there's a relationship breakdown. There's no option with the current lender. We've got options on that as well, which is a really unknown, untapped opportunity that can make a huge difference to people's lives. And then finalising at the end there with trust and building relationships. Again, with yourself as brokers, we want to make sure that we build a long-lasting relationship. So ask those questions of us. Ask us, well, can we do this case? Can we do the other case? Over a period of a few conversations, you'll get to know what we do. So it's first for intermediaries, first for clients. Probably the first thing to say on that is first for intermediaries. We want to make sure that you get it and get what we do. Then the clients, obviously, we want to make sure they're in a good place as well, and the service behind that as well. So actually finding those cases, you've worked hard to get those clients, working out hard to actually find a solution. We want to then back that up with first-class service as well. So that's the first part as well. When it comes to the team, there's actually myself looking after the team on the residential side. Then we've got Fiona, who's in the north, well, Scotland and the north. She doesn't like me saying the other way around, but North and Scotland or Scotland and the north, whichever you prefer. We've got Patrick in the south, London in the south. We've also got a new lady as well who's been with us for quite some time as well, actually, Ginny, who's in the east as well. So literally we've got support across the board there. Reach out to us, have those conversations, because we want to get to know you in that sense. We want to get to know and tell you all about what we do. And there's some really good quality people there who've done the job as brokers themselves in the past, who know the challenges, not obviously all of the challenges, but a lot of the challenges which you face, and we can help with that as well. So I'll hand back over to you, Paula, for the next slide. Yeah.
Oh, thank you, Keith. So let's see how we can help you then. So first of all, if you've got people that have got low credit scores, and we're talking probably about, 250 on an Equifax, then, those are customers that we are absolutely happy to help. It could be that they just haven't built up any credit at all. What we most normally see is complex income and complex employment. So it could be, for example, and this is a typical case I had recently, a doctor who was employed, self-employed, had consultancy income, had buy-to-let income, pension income. He wanted a mortgage up to the age of 75, and he also wanted it on a interest-only basis. Those are the layers of complexity that we can help with. And he also had a missed payment, but because it was a missed payment within 30 days that was paid back, then we actually ignored it.
So that's a mortgage. Is that a mortgage, Paula? That was a mortgage, wasn't it? A missed payment.
It was, yeah. It was a residential mortgage that we did. It was about 780. That one, in fact, we don't deal massively in customers that are in debt, just purely because a lot of the customers that we get, we offer that, but a lot of the customers that we get are complex and multiple income streams. So in fact, the average mortgage loan for our residential proposition is about 340,000, which, is quite high, especially in the specialist market. But we've got manual underwriters, and they offer flexibility as long as they can see sustainability of any income. We've literally got a catalogue of incomes that we can look at using for you. Debt consolidation, that's been massive, particularly, since the pandemic. People are wanting to pay off debts that they've got, or they may have car loans, they've had mortgage shocks because the mortgage payments have gone up, and they're looking at consolidating debt to bring down that lower income, those lower outgoings on a monthly basis for affordability purposes. The great thing about Foundation is that we don't have a maximum debt to income, unlike a lot of the high street lenders. This means you could have somebody that's on an income of, say, 30,000, £50,000 in debt, And as long as the repayments are affordable, we can absolutely look at helping that customer. And we don't make it difficult for them or insist that, the solicitor has to charge for making sure that everything is paid off. And we can, debt consolidate for virtually any purpose apart from paying off a tax bill, or if it was like, commercial finance, for example. Interest only, that was a dirty word not long ago. We're getting so many inquiries about interest only mortgages. Why are they coming to us? Well, the first is that for affordability purposes, we actually calculate it on an interest only basis, unlike the majority of the high street that calculate for affordability on a repayment basis. So that's great news. Also, we don't have a minimum income, unlike a lot of the high street, where you've got to be earning 50,000 or 75,000 as a minimum income in order to be able to qualify for one. We can go on true interest only without a repayment vehicle if there's £150,000 in equity in the property, or 200,000 if it's in London or the South East. So absolutely great proposition there. Also, you can do 70% on a interest only basis, but if you want to go up, to 80%, we'll do a 10% on a repayment basis as well. I did one of these recently for a guy that had seen his income dip after COVID, and he got 2 kids that were in private education. He wanted to keep them there. So he wanted to temporarily convert to an interest-only mortgage in order that he can carry on with the mortgage shock payments that he had and send those children still in private education. And he also raised an extra 10% to help with those school fees as well. So that's typically, the cases that we're dealing with. And on the back of that, we also do a wonderful pound-for-pound remortgage as well, with no multiple income cap, which is fantastic because it means that people that are coming to the end of the term with their high street lender can actually look at remortgaging with no maximum income multiples on a pound-for-pound basis. So if people are struggling, obviously to go to another mortgage lender, it could be because of their age, or, the next step is going to be doing equity release. They can come to us. We'll go up to 70 for a manual job, or 75 if they are a professional that, hasn't got any manual work. Foreign nationals, the USP with us is that we go up to the age of 85%, and we are doing loads of mortgages for foreign nationals at the moment. Normally we say we want them to have resided and have a history in the UK for 3 years, but we have looked slightly less if we've had professional doctors, for example, that have come over. So without any further to do, Keith, I'd like you to talk us through how we deal with professional, key workers and various other things, if that's okay.
Of course, absolutely. Yeah, no problem. Thank you. And go back to that previous slide, don't move backwards, but in the sense of it's that tailored approach we take. So it's when it comes to interest only, actually, let's look at the period for a period of time. I need to change my costs for a period of time. Let's tailor that. And that's what you're referring to there. There's lots of options in that space. So reach out again for even more detail on that. We're turning to professionals on this as well. The key thing about professionals, we can stretch and give it a higher multiple. So it's 6 times all acceptable income. And as I emphasize the word all, it's obviously their actual professional income. It could be land and property income, it could be investment income, it could be other areas of income we can take into account. That professional qualifies for the 6 times multiple. At the same time as their partner actually qualifies as well for the 6 times multiple. And the combination of the two makes a huge difference. So you could have a part-time dentist and a certain level of income, and their partner is earning more but not deemed to be a professional. It will give 6 times all of that income, and that can make a huge impact on that as well. It comes to obviously two people involved on that, 85% loan to value. It's a 2-year or a 5-year product. And again, we've seen some cases I dealt with recently where there's a trainee architect, and we were able to do the 6 times multiple for that person on an income of just over 40-odd thousand, and it just made sense. We could do that. That professional's got that level of growth on their income. So again, we can really help out with those cases. So professionals, they're doctors, dentists. There's a few unusual ones in there. Chiropodists,
Accountants, actuarials, medical, pharmacists, doctors, dentists, barristers,
Engineers are in there as well, aren't they? Engineers are in there. Yeah.
vets. I'm sorry, but we haven't got mortgage professionals on there, but Keith and I are trying, aren't we, Keith?
We are indeed, but people with mortgage professionals earn loads of money already, so they don't need this. So it's not an issue. But yes, professionals really strong in that space. We do 6 times income for them and their partner, and again, all the elements of income around that. We can obviously include all of those. It does make a huge difference to what potential borrowings that client can have. Can we go to the next slide, Paula, on that one? So key workers, a similar line on that as well. We're looking at 5.5 times income for key workers, so the teachers, nurses, ambulance, prison, police officers, etc. All the people relied on over the course of the last, well, bizarrely, it's 5 years next year, next March, since COVID started. I can't believe that's the case, but all these people we relied on sort of 4.5 years ago, they would benefit for us with 5.5 times their income. Then their partner, whatever they do, it's 5.5 times on that as well. So you could have a situation where it's a teacher and somebody who's self-employed on 1 year's accounts, it's 5.5 times the whole lot. And again, that can make a huge difference on that basis as well. So that's available on the F1 range as well.
And we had that recently, Keith, where we had a nurse that was on 30,000 and her partner was nearly on 200,000 in IT. And obviously we could look at 5.5 times the lot.
The whole lot. Absolutely.
It really does make, a massive difference, doesn't it?
It does indeed. So again, it's the option again, not forgetting the fact that on the edge, the income that's on land and property income, investment income, it all pulls into that same picture as well. So yeah, we can help with that as well. Then we mentioned earlier about joint borrower sole proprietor being obviously one of the options with ourselves. So again, trying to be innovative and find out those options and how we can actually make life easier for a lot more people. When it comes to JBSP on that, we're looking at sort of 4 incomes taken into account. There's up to 2 individuals who live in the house and 2 individuals who don't live in the house. And again, they're family related down as far as aunts and uncles in that family tree. And again, we can help with those cases as well. So all the income into the equation, 2 people live there, 2 people don't. And again, we can those cases can work really well. We've got F1 and F2 credit criteria, which we'll explain a little bit later on in this presentation as well. Purchase and remortgage. The key thing that's also very useful on that as well is using obviously repayment strategy of repayment itself if the persons are young enough. But again, it's tailored approach when it comes to the part and part approach or interest only approach on that. So you've got perhaps parents who are involved in this who are perhaps my age. It's quite a scary thought actually. Sort of looking at a shorter term. I'm not going to say what term that would be because I'll give my age away. But in the sense of those shorter terms, just working out how we actually do that. Well, actually, you can do part on interest only, part on repayment. Actually, the affordability is fine with that as well. Let's tailor that to make that work in the right way. And obviously then they can move forward on that basis. So there's lots of options on that. And it's 4.49 times all the incomes. So again, there's a real opportunity in there to sort of work out and help out that next generation for that leg up to be able to buy a property as well. What else could I say in that space as well? Probably not too many other things to say, but it does what it says on the tin. But the one thing to say is you can't be living there if you're a non-occupier, which makes sense, doesn't it? You're a non-occupier, so why would you live there? So yeah, it's a case of I don't live there. You can't. I'll get myself confused there, aren't I? So literally, you're a non-occupier, so therefore you can't live there. So and that's the situation. When it comes to the overall position on income, again, this is our key strength. Income is what we're about. Not that sort of the credit profiles, which you can help out with, which we'll show in a moment. But looking at the incomes on there, 100% of bonus and commission, 100% of second job income, 100% of trust income, 100% of maintenance income if it's court order. We'll consider it if it's not court order as well. 100% of pension income, maternity and paternity leave as well, 100% of that. So somebody's got, I'm returning to work in September. Here's my letter from my employer showing me my 30,000. We're fine, we can work with that. Net rental income, less the finance costs, 100% of that as well. 100% of investment income. And obviously then benefits income, we take 50% of that. But again, if it's child benefit, we won't take it if they're 14 and above. So we need to also take that out of the equation. But there's a lot of generous figures when it comes to income. We want to maximise the amount of income that's taken into account on a case to work out that next step forward. So going back to what we said on that first slide that said first, flexibility is where we're about, then income being the second one. And this just shows the power of what we can take on income. And then combining that with the options on repayment strategy, and looking at the sort of key workers and professionals. There's so many options we've got available to us that really do help out a lot of clients on that.
And the key word, Keith, what we always say to brokers is sustainability. If you can give us an income and we can show that it's sustainable, we will use it.
Absolutely. It's just making common sense, isn't it? It's, if it makes sense, and you've got a mortgage of 25 years, you don't want the income to fall away after 12 months. So we need to make sure it's there for that 25 years as best we possibly can. So going back to where we are now, manual underwriting, again, I mentioned it earlier, but manual underwriting is great. And it's 20 years ago when I was involved in mortgages, nobody wanted manual underwriting. Let's get the system to decide. Now it's a case of the system doesn't quite do the job. And there's a lot more people who need that sort of approach where there's a sensible analysis of a case. And actually, that makes sense. Let's do that case. Let's make that happen. And that's what we're about. The accounts, 1 year's figures, 2 years figures, etc. Net profit and salary. There's so many good areas on there. Directed deductibles, 50% added back in. CIS workers, we look at the last 3 month slips. So actually, let's look at that. That's the average. Let's do the 46 weeks of that. We're comfortable with that figure. We're okay with that. Pension contributions ignored unless obviously you're in retirement. But we can, that's obvious as well, really. But we can take those. Well, we don't take those into account. There's so many options on that. The one I want to jump into as well on there is bank statements that aren't automatically required on a case. The beauty of what we do is when you've done a case, you do a decision principle, and that is a soft footprint which confirms the case is either declined or accepted. If it's declined, we'll look to work a way forward for it anyway. So do contact us if you get a decline from us, because we want to make sure that actually, is there something you've missed? There's something we can actually find out on that. Let's work on that case. If it's accepted, you can move it to an application. And the key thing that's really simple about us as well is put the application into us, pay those fees, and then literally don't send us anything at all. We don't want anything from you at that point. The underwriter will contact you and tell you what we need on the case, and you upload those individual items that we need on the case. So you give us War and Peace, you give us what we need, which does make an awful lot of sense. And then we can literally move that case, get the valuation in, we've got the information we need, assess it and move it forward. And we had cases recently offered in 3 days. And I think that's including evaluation, which is remarkable, really, especially for a specialist lender. We want to make that specialist lender in a normal high street approach. That's the key goal on that. Sorry, I'm getting carried away now, sorry, Paula. But when it comes to us as a lender on credit, I mentioned about the fact of all the things we do first of all, and then it's at the end of it, we can still do that despite the fact there's a credit issue on the file. And when I say about credit issue, we can go from, we've got four key areas on that. We've got the foundation one called F1, which I think in a Formula One sort of approach on that. They're the speediest sort of quality cases there. No issues on credit. Perhaps I've had a CCJ 4 years ago. They're all satisfied. I'm comfortable with all that. I've had a credit card, status 3, but that was 7 months ago. You're in our F1 range, and you can, we can deal with that case. You get the best rates, etc. Then you've got the other end of the scale, the F4, which again we can cater for as well. That's got loads of opportunity in there. So CCJs on the screen there, you can have them over 6 months ago. And they can be unsatisfied up to the value of £3,000 as well. You've got defaults again with a situation where over 6 months ago, you might have a DMP, you might have some of the missed payments in there as well. Bankruptcy, IVA, etc., satisfied 3 years ago or more. We can help out in those cases which are more severe. So again, if you're going down that route of income first, all those different options, you think, oh my God, there's an issue on the credit file. There's a lot we can cater for on that as well.
And if you've got anybody that's got a missed mortgage payment because they've had the mortgage shot, the payment's shot up, they haven't been prepared for it, but they've quickly paid it back within the 30 days, we won't class that, will we, Keith?
Absolutely.
Payment.
You read my mind. I was just about to mention the point of a mortgage payment. That's all right. I dealt with a case recently where somebody had a buy-to-let mortgage, which they messed up on back end of last year on their mortgage payment history. Somebody thought the other person had done it, and they missed it by a couple of weeks. And all the lenders out there were saying, sorry, you got arrears on your mortgage, can't help you with that at all. Then literally we said, well, actually, you paid that. It wasn't an affordability issue, it was an admin error. You can see that. we can take a view on that. They also had a credit issue as well, and again, we sorted that out. So it's really a case of we can take an approach that's sensible on that, because you haven't missed it. You just, yeah, speak to us. That's what it's about. So Paul, over to you with the residential green proposition. Yeah, go for it.
Yeah. So, like all lenders now, you know, we've got our green proposition, and with our green, as long as they've got an A, B or C EPC, we will happily look at them. If you don't know what the customer's property is, go onto the government website and put the property details in. If they've had one done within the latest 10 years, it will tell you. My property, for example, I had done about 8 years ago. It's a D. I've only got to put electric energy performance light bulbs in to get it up to a C. So if you can get a better rate by your customers by that little bit of extra added value advice, then please do. So that about concludes the presentation. What I'd like to do is, first of all, ask you if you can click on that QR code and register with us. It literally takes 2 minutes. And basically, you know, register with as many specialist lenders as you can, because obviously the more that you register in and get the relationships with them, relationships are so important. We get so much business because people know that they can count on us, you know, to be available, to, you know, make sure that we can do the case to outset and then pull out all stops to make it happen. We're going to go on to questions now. So I'm going to return to Anna, and I'll stop sharing the presentation.
Hi, Paula and Keith. Thanks so much for that presentation. I'm just going to wait for, and there's Lisa. Fantastic. I think, Paula, I can still see a bit. There we go. All great now. So we have got some questions in from the audience, and one of the questions is about IT professionals within the professional range, and the question specifically is about why they're not at the higher income multiple level. But I suppose maybe a way to rephrase the question is about how, you know, would you reconsider certain professions? Is that kind of consideration ongoing at which income multiple tiers that they're at?
I'm going to hand over to our underwriter, Lisa, but we have got a stipulated professional range. I mean, we always welcome feedback, and we can always take feedback back. But Lisa, I'll hand over to you. I know it's not one that we're able to help with yet.
No, it's not, sadly. So it would be the 4.49 times for those at the moment. But yeah, we are happy to have anything fed back by the business development managers, because it's always evolving. We'll always try and fit in the marketplace and you know, adjust where we can. So it's always like handy to give some feedback.
Absolutely, I'll pick up that.
Self-employed, it's good if they come to us with the accounts, because it could be that they've got a car loan that they're paying for that's going through their accounts, but it could be that it's personal, and sometimes you won't double deduct those, Lisa. You can actually take them out, can't you?
Yeah, and we can also use at the moment we are using profit before tax and not profit after tax, so that's a big plus as well, because I know not every lender does that. So that does increase the income that we're able to use, so hopefully that would help.
And if they've got any other income, it could be that, you know, they're IT, but they've got like other jobs as well that they use, and we can look at the overall picture. But if you do speak to your BDM, get the accounts to them. We'll have a look at the accounts for you, and we'll say, look, you know, we don't need to take this into consideration. We could actually look at using this as income. If there is a possibility we can, rest assured we will.
Right. And I've got another question about whether you can help deal with clients that have been out of a DAS scheme for a year, and whether you accept non-owner occupier buy-to-let clients that do not own any property at all, which I think is more of a buy-to-let by foundation question, but I'm sure that you guys kind of communicate with them as well. So is that, I don't know who wants to have
Do you want to do the DAS one, Lisa?
I'm just checking, to be fair.
Is that it's the Scottish scheme?
Yeah, it is. Is that the equivalent of?
It's basically like having a
relief order.
Is it an IVA?
No.
What one is?
It's the Scottish scheme. I think it's having like a default, is it?
Not too sure.
Maybe we can revisit that one whilst Lisa is looking at it.
The other one was it for somebody buying a buy-to-let that doesn't own a residential?
Non-owner occupier buy-to-let clients that don't own any property at all.
We can't.
Strictly speaking, we don't do them. However, there are situations where we possibly could consider a vicar that has a tied property but obviously wants to get on the land ladder, a publican that might have. We had one not so long ago that was a live-in carer. She cared full-time for somebody and accommodation came with that job, but she wanted to get on the property ladder. Another situation may be somebody's living and working in London, Anna, and they're paying astronomical rent. They can't afford to buy, but you know what? They're going to get on the property ladder and buy a property in Manchester. Have a chat with us because, strictly speaking, we don't. What we're worried about, like every other lender, is backdoor resi. But if you can, have a chat with us in those circumstances, as long as we can see good rationale, we would consider if they were renting in an area and then just wanted to buy a buy-to-let not far from them, it'd have backdoor resi written all over it. We'd be really concerned.
Yeah.
Okay, but that does make a lot of sense. Lisa, you look like you've...
I've just looked. I think a DAS is basically the equivalent of a DMP. So on our schemes, DMPs on F1 we don't consider, but F2 to F4 we will consider DMPs as long as the payment has been made for the last 12 months. So we just need like the 12-month statement.
Yeah. Great. I have a question here on joint borrower sole proprietor. Does it matter if the third party has their own mortgage?
No, it doesn't matter. We will just factor that in as a commitment into their affordability. So it doesn't matter if they've got one.
Great. And yes, it was the person who asked about the DAS. She said, yes, it is like a debt management plan. So I think we've answered that question. So that is great. So we've got, like looking ahead for the coming year, we've just had the King's speech today. Actually, I was cheekily checking my phone whilst the presentation was going on. I was trying to do two things at once, and there is a lot of stuff about housing and planning and stuff in there. What do what's the impressions on that? I suppose for you guys, do you think that it's to have housing more at the top of the agenda is a good thing? And do you think that this might help more complex residential customers?
I think it is a great thing. I mean, there is such demand for housing in the UK at the moment, and, we're just not fulfilling it and haven't been for a long time. Obviously, they've got a commitment to build a lot of property. They're talking about building on, I think there was on the television this morning, on a lot of industrial wasteland to start off with, but they are also considering greenbelt areas. And the thing is, realistically, if they do consider greenbelt areas, it's going to be years, Anna, before they've got planning permission. There'll be protests, there'll be appeals, there'll be court cases. And then obviously you've got to go to planning. That will take years to go through. So, even if they decide that they are going to build on greenbelt, I can't see it, making a really quick decision. And then they're going to look at, some of that industrial land, but it's got to be good, more properties. I think the challenge that all the specialist lenders realise that we're going to have mainly is the fact that, these properties are so expensive now. What is it? The average property in the UK is about 282,000 roughly at the moment?
Yeah, I think ONS came out today and said it was 285,000. I will, that was me just, just skimming before I came on, but I can double check those figures.
But, if it's say roughly 282, 285, first of all, young people have got to find deposits for these properties, and it's going to take them years to save up. So I think we need some innovation. First of all, well, how can they manage the mortgage and maybe manage to get a deposit as well, especially if they're renting, they're not living in parents, or, the average rent in the UK is astronomical at the moment as well. I mean, what's it, about £1,800, I think, if you look inside of London, and then probably average the UK 1,200, maybe 600-700 up the northeast. It is a real struggle, and I think we've got to be really innovative how we look at using, you know, complex incomes. People with higher incomes, why should they have the same affordability if you're on 100,000 as you do 30,000? You've both got roughly the same outgoings, so maybe looking at income stretches for those, and increasingly looking at, you know, 1 year's accounts. Young people, apparently 9% of people between 22 and 30 want to be self-employed. They're coming out of college, they want to be coming out of education, they want to be self-employed. So it's how we can help those people. Yeah,
I think that is really, really crucial. We've got another question on the joint borrower sole proprietor, which is if it's a couple doing joint borrower sole proprietor and one party is too old, 66, can they be taken off the existing mortgage?
I don't think I understand the question, really.
So is it currently a remortgage that's coming to us where one wants to come off because they're 60?
Yeah, I think so.
Yeah.
I'd say no. I mean, we don't. If somebody's married or in a long-term relationship, we do 99% of the time insist on a joint application. So it's just sort of varying it to fit.
Yeah.
So it wouldn't. We do remortgages in sole name to sole name with a married partner because it's already in sole name, but we wouldn't be looking to take somebody off to just fit the criteria.
Yeah, makes a lot of sense. We have a question about so a client has a mortgage legal contract with their parents. How does this work with you guys? Is it classed as a commitment? You know, so I think it's not necessarily. Yeah, I suppose it's different to a joint borrower sole proprietor because I'm guessing it's something like a gifted deposit in that sense. That's my assumption, just based on the wording of the question.
I got the impression it meant if somebody was applying and they had already had a contract with the mum or on the mortgage with their parent, we would factor that in as a commitment. We don't do second homes, so we'd have to be happy that it wasn't a second home. So, for example, we'd look at the voters roll, and if it is only the parents on that voters roll, and we're happy that the parents are the only ones living there, then we'd still factor in the mortgage because they are legally liable for that payment. But we would look to do an onwards residential for the applicant, yes.
Okay. Makes a lot of sense. I suppose there was a lot of things we touched on that was touched on in the presentation. Some things that I thought were really interesting is you know, growth in interest only, foreign nationals, and debt consolidation. But I suppose looking ahead, what do you guys think will be some particular hotspots, particular kind of areas of demand in the coming year? Do you expect there to be much change, or do you kind of expect there to be it to be kind of similar to now?
I think we've still got a lot of people that are coming into mortgage payment shocks. There's still a lot of people at 1.99%, and it's not until that they've realised that shock. It might be that they haven't acted quick enough on a PT and they go that nearly month in arrears, and they need to look at a specialist lender to just use maybe for a couple of years until their credit repaired, if you like. I think we're going to see a lot more people with missed mortgage payments that are going to be looking at solutions moving forward. People needing to refinance as well, Anna, because they're coming into that mortgage shock and then they think, you know, I've got a car loan, I've got a loan for the sofa. What I need to do is remortgage to bring my payments down. So it's, you know, that debt consolidation in order to be able to afford the increased mortgage payments as well. And also people with CCJs, if we look over people that have like aggregated over the last 6 years, I think there's around 4 million people in the UK that have got CCJs, and that's about 12% of the working population. So it's obviously important that we're going to be able to help with some of those. Sorry, Keith, were you about to
I was going to jump in as well about the pound for pound remortgage as well, because again, relationship breakups, not many options for clients and brokers there. And again, we can help in those spaces where the one party wants to keep hold of the house for their family, you know, to stay in, and actually the other party wants to leave. We can work on those as well to sort of, as long as you're not actually increasing the borrowing levels, we can make that pound-for-pound remortgage work really well. And again, the other options, if you've got lenders without PT options and they want to change what they've got, again, the flexibility we've got in that space is crucial. So that's always there as well.
Great. Well, I think that is unfortunately all that we have time for. The questions do get saved to the system, so if there are any specific questions that can be answered, we'll do our best to answer them. Just also as a reminder to please subscribe to our Mortgage Solutions and Specialist Lending Solutions newsletters, because then you'll get notified about great masterclasses like this, and you can also follow us on our YouTube channel where this masterclass will be put up, so that if you do want to share it with people, or if you missed it, or a client or colleague missed it, then you can watch it then. So thank you so much for Paula, Keith and Lisa for your insight today. I found it very, very insightful, and yeah, thank you so much.
Thank you, Mortgage Solutions,
Thank you.
and for everybody for watching us. We really appreciate it. Thank you, and we more appreciate the business, and we'll make sure we look after you too.
Have a great day all. Thank you.
Thank you.